Ben Smith here with Cove Financial Planning. Want to talk through a question I'm getting quite a bit these days, which is how do you prepare for a market downturn? I don't want to raise any big red flags here, but obviously a lot of headlines going back and forth. A lot of talk on the news about where the markets are headed. The reality is we're in the longest bull run. We're in the longest uptick in U.S. stock market history. It's been 11 years since the 08-09 recession, housing bubble. We've had up markets since then. So a lot of people might say, hey, we're due for a market correction. So again, I want to provide 3 easy things you can think about to prepare for a potential downturn. Number 1 is diversify your portfolio. All that means is own a lot of different things within your portfolio. So for a lot of folks, that means don't just own U.S. stocks. I see that a lot where people come in and they have a lot of different U.S. stocks. It's not enough. So I want to provide a quick analogy. Excuse my illustration and art skills, but imagine 2 elevator cars, right? Car number 1 and car number 2. Imagine that you're moving into a new apartment and you have the option to take this car or this car. You'll notice elevator 1 has just 1 rope connecting the car. Elevator 2 has 3 ropes connecting the car. Now, if the rope in elevator 1 weakens and snaps, you might be in trouble, right? In elevator car 2, you have a little bit more support there with 3 total ropes. So think of these ropes as different asset classes. If you own just U.S. stocks and U.S. stocks go down in value, your portfolio is going to go down in value quite a lot, right? We saw that happen in 2008. Now, if you own U.S. stocks, non-U.S. stocks, bonds, maybe alternatives like real estate, commodities, things like that, you're going to have added protections in your portfolio when a big asset class like U.S. stocks, for example, go down in value. So pick car number 2. Give yourself the peace of mind of owning a lot of different things in your portfolio. Number 2 is maintain a cash reserve. So you want to have 3 to 6 months of your living expenses set aside in a checking savings account, easily accessible. The reason is, heaven forbid, if you need to access that money, if you have an unexpected expense, you don't want to draw on your portfolio or on your investments when it's going down in value. So that way you can keep that intact. You can pull on your emergency funds if heaven forbid something does come up. The last thing you want is to pull money from your investments when they're going down in value, because you've just made that loss real then. Now, on the other hand, if you keep your portfolio where it's at, you weather a downturn and don't touch it, chances are you're going to get right back to where you were. Like again, we saw in 08-09. So keep that cash reserve. It's really important with a volatile market. Number 3, easier said than done, but keep your emotions in check. Right? We're all human beings. We have this fight or flight mentality. So when something scary pops up, it's natural, it's normal to think, okay, I have to run away from that. I have to do something to protect myself. Oftentimes, especially if you have a long time horizon, the best thing you can do when markets go down is to do nothing at all, right? Or maybe buy more, right? If Target is having a big sale, you probably want to fill your shopping cart up when prices are lower. But again, think about your risk tolerance, your time horizon, and how that is in accordance with your emotions, and make sure you're not making quick decisions with your investments just because the market's volatile over time. So again, diversify, keep a cash reserve, and keep your emotions in check. A second opinion never hurts. If you have questions on that, feel free to reach out at ben@coveplanning.com.